Yes, we've been getting the best and the brightest from the JP Morgan conference, and it's now time to talk economics, Indian economy, simply because, for one thing, we have a monetary policy coming up on October 4th, the maiden policy from the new governor. Well, Sajid, this policy is new for several reasons. Yesterday, Shaktikanta Das told us that an MPC may be in place. I mean, he was giving a 99% certainty that it could be in place even before October 4th. So, what are you looking up to? First, the macro data, what is it pointing to, and then the institutional change.
So a couple of things. One is that clearly you've seen the expected decline in food prices materialize, and I would argue September has seen in the first 15 days an even greater momentum of price declines for things like pulses than August saw. So we do see inflation dipping below 5% in September, and that means some space for monetary easing is opening up. I want to caution that we shouldn't confuse cyclical and structural dynamics. The fact is this is going to be cyclical. Inflation could go all the way down to 4%, but then mean reverts in the first half of next year. All of this is led by food. Core inflation is stuck at about 5.3, but the fact is if you've got a 5% target for next March, some space for easing is opening up. We think the RBI, whether it's the governor or the MPC, will not front run the inflation. I think in October, perhaps the risk bias on their forecast is changed to reflect downside risk to their 5% target, and thereby setting the stage for a rate cut, we think, in December. Between now and then, the focus will be very much on liquidity management.
No question of two cuts then.
I'd be surprised by two cuts. Because this is led by food, because food is so volatile, and because the monsoon has been 10% below normal in August, 25% below normal in early September, that creates some risk about how all this very strong sowing translates into production. You don't want to cut in October and then be unpleasantly surprised by food prices not declining in subsequent months. So I would think prudence would
but we've realized over the last 24 months that rate cuts is non-news. Liquidity is news.
Exactly.
How do you see liquidity management by the Reserve Bank moving from now to March?
The fact is the RBI has walked the talk. In April, there was a lot of skepticism about how many years it would take to get there. They've taken the deficit quickly to neutral, in fact, to surplus, and that has involved a large quantum both of FX purchases and open market operations. Our estimates are they've done 1 lakh of OMOs and 100,000 crores of FX intervention. Now, the problem doesn't get any easier because in the second half of the year, our estimate is currency in circulation is going to accelerate even further. We link this very much to rural dynamics, that rural demand picks up, demand for cash picks up. That means to keep the system in balance, you'll need to do a lot of open market operations. Our expectation is if you don't get much FX opportunity to buy, you may have to end up doing 1.5 trillion of OMOs just to keep the system in neutral. Right? And with FCNR outflows, it's not clear how much scope there will be for FX purchases. So the RBI has got its task cut out, but I think in the near term, if you're going to cut rates in the coming months, you want to maintain this easy liquidity policy to get the transmission. A year from now, if the inflation guidance changes, then we'll have to come and revisit this.
But doesn't this make it easy for the Reserve Bank, therefore, to buy dollars probably starting December? I mean, you admit that there is a need for RBI to print more notes, and we know, despite the very strong denial coming from Shaktikanta Das yesterday and even Mr. Sitaraman, that the government will like a weaker currency simply because that will mean that much more export jobs. So isn't it a great situation for the Reserve Bank to be in, to buy dollars simply because, yes, we want a weaker currency and we need to replace cash?
Two slightly different questions. I agree. And the RBI has demonstrated that. They've been buying FX at every opportunity. I think, A, primarily because their policy has been to keep the real effective exchange rate broadly in the same range to avoid pressures of appreciation in a world where everybody wants to depreciate. So that will continue. The question is, will you get that opportunity if, A, you've got the FCNR outflow in the next few months, and if you're looking at a Fed rate hike in December and, the BOJ or the ECB were to walk back slightly their negative interest rate policy, will this risk rally towards emerging markets that's continued the last 6 months continue on beyond December? If it does, I have no doubt the RBI will keep doing what it's doing. Very quickly, I think on the devaluation thing, I think we shouldn't overstate the case. The word devaluation is a construct from the 1980s.
Yes.
Right? This is not a government-set exchange rate. Right? This is a market-determined rate.
Depreciation is the word.
Exactly. So I think anything that happens will be very gradual, very calibrated. I don't think market should get spooked at all.
Okay. So what kind of a rupee value will JP Morgan look at?
Lata, I was learned in graduate school that it's predicting exchange rates and commodity prices is a mug's game. What I will say is the RBI has been looking closely at the 36-country real effective exchange rate. That's the ultimate measure of competitiveness. Okay. So the dollar rupee value is a function of how cross currencies move.
Okay. Okay. I won't get into the mugs game, but very quickly, how does the MPC skew everything? Can the MPC prevail upon the governor to cut more, to give more liquidity, to buy more dollars? What may the MPC do?
I think, A, it's a great concept because of the way it's been structured. You've made the point recently that you only allowed one term for 4 years. So I think the RBI Act is a very impressive detail. I think the MPC, like the governor, will be data dependent because I think the degrees of freedom that the MPC has to operate ultimately are bound by what's in the RBI Act, which is that we want to get to 4% and the upper tolerance band is 6%. So nothing the MPC does can violate that statutory obligation right now, which is why I think there'll be a lot of policy continuity going forward.
Okay. Well, the great debate to have now is, will the MPC and the governor move towards the 4% inflation rate at all? But we have to postpone that debate for another day because I guess that discussion will start in December or in January, not just yet. And today the markets are on fire, so we'll have to hand it back to the equity gurus. Back to you, Subera.
Thanks very much for that. But the equity gurus are